Hi, everyone. I'm Claire Hanold, and I lead sales strategy and category management here at Chomp.
Hi, all. I'm Lauren Ramsey, and I'm a sales operations analyst at Chomps.
So, why are we here today? With inflationary pressures high and consumer shopping patterns shifting, we wanted to highlight primary economic indicators and how they are impacting us with a new industry update.
The macro environment is rapidly changing, and it's becoming more important now than ever for companies and emerging brands to pay attention to what's happening. But understanding economic trends is not always easy, and that's where we come in. Today, we're going to go through 5 key macro trends that you should be paying attention to and why. So starting off with the Consumer Price Index, or the CPI, this is a monthly measurement of inflationary pressures and how they've changed on a yearly basis. The Fed traditionally targets a 2% yearly increase, but over the past year, we've seen numbers hitting almost 10%, as volatile food and energy prices skyrocket. After hitting the largest increase in over 40 years since 1981 in June, CPI did drop slightly from 9.1 to 8.5% in July. The update was released this past Wednesday and found that much of this drop can be attributed to declining energy prices, specifically gasoline. But on the other hand, food prices continue to rise. Specifically, food at home rose to 13.1% on a year-to-year basis. Even with this indicator continuing to rise, this is the most encouraging report we have had in some time. The Producer Price Index, or the PPI, is a very similar measure, but it represents the wholesale prices, which are ultimately driving up the inflationary pressure for consumer goods and the prices that you see in the store today. The July data, which was released yesterday, showed a drop of 0.5% from June to 9.8% year to year. This marks the first monthly decrease since April of 2020. This does show that the economy is moving in the right direction, and producer prices are expected to ease as the supply chain continues to improve. However, many economists agree that it could take as long as 3 months for supply chains to ultimately impact consumer prices in store. Now, both of these indicators have had an impact on consumer confidence. Consumer confidence measures the expected optimism in the economy, and there are 2 main reports that show how consumers react to it. So basically, we look at the Conference Board report, which was released for the July data, and it showed wavering optimism, particularly as recessionary risks continue to increase along with ongoing interest rate hikes. However, the Consumer Sentiment Report released by the University of Michigan for August did show a slight rise in consumer optimism as a whole, but remains near record lows at 55.1, which is more than 20% lower than last year. This comes after inflationary pressures have been hitting the economy for the last few months and as gas prices dropped slightly within August specifically. This consumer sentiment survey is also more reflective of the volatile prices we are seeing in our economy. Then the Purchase Manufacturing Index, or the PMI, is an index that reflects the health of the manufacturing index on a basis of production, employment, deliveries, and inventory. So the PMI registered growth for the 26th consecutive month, to no surprise, as the economy continues to expand and supplier deliveries improve. However, supply chain issues continue to be at the forefront for most industries, especially with inventory growing. A lot of these supply chain issues were initially fostered by a larger demand for good over services during the pandemic era, and they've continued to be fostered and accompanied by a high quit rate and manufacturing hiring difficulties amid these rising inflationary pressures. Lastly, we want to touch on real GDP and jobless claims. So GDP is the broadest measure of the economy and measures the total level of goods and services produced over quarters. Ultimately, this declined by 0.9% in the second quarter, following a decline in the previous quarter. This marks the second straight decline and is a strong signal of recession. Since 1948, the economy has never seen 2 consecutive declines without being within a recessionary period. However, it's not expected to be officially declared a recession with the ongoing strength in the labor market. While we saw jobless claims slightly rise over this last week to 262K, they remain at the lowest level in the last year. Claims have been moving slightly higher from this 200,000 mark, suggesting that the labor market will slightly slow in the second half of the year. But overall, it continues to be strong and resilient, seeing hiring surge in July with employers adding over 500,000 jobs. Again, despite the decline, the resiliency of the labor market, contradictory to most recessionary periods, has outpaced the wavering confidence and inflationary pressures, which is ultimately keeping us out of a recession today.
Thanks, Lauren. So the question is, how does this impact brands and retailers today? As Lauren shared, inflation is up, especially food at home, with record high increases, and consumers are paying the higher price, with nearly all noticing this change and therefore changing their purchasing patterns. As these prices rise, consumers are shopping less and purchasing fewer units. Snacking categories in particular are taking the largest hit, growing plus 19% year over year in July, outpacing total grocery, who are seeing prices increase plus 15% year over year. Even with consumer snacking more than ever, price pressures are forcing consumers to buy less. For Chomps, the meat snacks category, and more specifically meat sticks, are proving to be more resilient to price pressures, driven by the large increase in new households buying and repeating purchases. Even with inflation on the rise, we recommend digging into the data to find the right story to help your brand and retail partners continue to grow amidst the headwinds. We hope you found this helpful. If you're interested in hearing more, tune in to eNumerate with our partners Numerator on August 24th to hear how we think big. These insights are just one of the ways that we do that. You can find the sign up link in the notes.
Thank you so much for joining. Tune in next time for the latest economic update.